The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Was Ray Dalio right all along? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're kicking you off to the closing bell here in the U.S. on a day when we are seeing that debasement trade that Ray Dalio was talking about in play. We do have the 30-year yield moving lower today, but still relatively elevated above that 5.2% level, and Bitcoin higher on that, up about 2% right now to that almost $79,000 level. What's getting crushed, though, in this equity market? It's semiconductors, those chip stocks falling. What does it mean for the index level? Well, not much movement right now. That S&P 500 only up about, or only down about 0.2%.
Yeah, you know, Emily, typically the final full trading week of August is typically supposed to be a snoozer, but this week promises to be, well, anything but that. Scott Bessent may be trying a bit too hard to nudge yields where he wants them, while Kevin Warsh maybe not trying hard enough. And then you throw in earnings from the largest publicly traded company out there, Nvidia, and those how I spent my summer vacation essays, they're about to get a lot more interesting. Let's take Nvidia for a second. That stock, a 6% drop from where it was when it last reported earnings 3 months ago, and 11% below its last record high. In fact, the Philadelphia Semiconductor Index as a whole down more than 20% since its June 22nd record, with 29 of the 30 index names in the red over that 9-week stretch. It's part of what has clearly been a pronounced rotation away from that core AI trade into almost everything else, sort of. Linked to that rotation, but still a standalone story on its own, is the swelling stare down by buyers of U.S. Treasury debt with the top U.S. bond salesman out there, Scott Bessent. It's not that the bond buyers won't buy. They almost certainly will. The question is what price they demand to take on the mounting and foggy fiscal and inflationary risk.
If we see 5% on treasuries on the 10-year, I would tell you that is a buying opportunity. The 30-year, however, historically has traded much more on inflation concerns. I don't see us going to 6% on the 30-year, and if it does, I would take the opposite view and I'd back up the truck. And I buy a lot of 6% 30-year treasuries.
And Walsh, speaking a little bit earlier, and this is certainly a cross-asset story. Whatever yields do certainly has an effect on everything else, from gold and, of course, to the dollar as well. As we kick you off to the close here on this Monday afternoon, let's bring in Kamal Bhatia. He's the CEO of Principal Asset Management. And Kamal, great to see you once again here.
Good to see you, man.
And I do want to start off with the rate picture, but also more from a cross-asset sort of story here. There's obviously this general consensus now that rates to a certain degree are probably going to be higher, maybe a smidge or two, but no one's really seems to be betting on any material drop. A, do you believe that? And if so, what is the reverberation through other asset classes?
So look, you're right. The long rates are certainly going to be higher. I think two things have shifted in this marketplace. One, the Fed is only in control of the short rates. The market has taken control of long rates. It's been a while since we have seen that play through, and that's going to have an effect across the marketplace. Two, that means every asset class has to react differently. We've seen that in equities and fixed income as well. So the longer rate is the one to watch because the market's in control there.
Is there a level that you look to, particularly with the longer term yields, where you think that could be materially problematic for the equity trade?
Not right now. I think partly because we have inflation and term premium going up, but growth is pretty good.
Economic growth.
Economic growth is pretty good. And it's not just here. It's in globally, economic growth is pretty good. There will come a point where if growth sees a hiccup and inflation keeps on going in the other direction, the long rate will react very viciously.
Is there a level in the 30-year yield that would cause the Fed to move in? Because you're saying the market's in control. How does the Fed react then?
Well, first, I think the 30-year, while it's valuable for a lot of long-term investors to model their portfolios, the 10-year is really the most important rate to look at. That's, if you are a CFO today, that's what you're looking to model your business projections. If you're an investor, that's what you should be looking for. So the 30-year, I think, is not the right rate. I would argue the 10-year is the right rate to look at to figure out where the economy is really going in the longer term.
When you think about kind of what these long end rates are saying?
Yeah.
What are bond investors kind of telling everyone about inflation and about the macro environment right now?
So first of all, bonds investors should be really satisfied today. They have been chasing spread. They've been really effectively trying to figure out if spreads widen or contract to earn their outcome or yield. And the rates resetting give them some comfort. Now, the downside of that for bond investors is they have very little to work with now. Yields are the spread is so compressed that if you pick the wrong credit, you will have losses on the credit side. And that makes it very tricky to be a bond investor right now. So the end investor is much better off. The fixed income managers have to be smarter in this environment to pick the right credit. So it's a different situation now in the marketplace. Does that create maybe a little bit of stasis? I mean, we had the head of PGIM's business, fixed income business on last week, and he said something similar. He kind of quipped that, you know, he's a credit investor who hates being a credit investor right now. Yes. Yeah. You are so right. And then I would expand that, Romain, to say the credit market is not just public fixed income. There's a very, very large and growing private credit market. And so from my standpoint, I would look at credit across both public and privates. And I know for the longest time, people have to choose between one or the other. I would say this is not the time to choose between one or the other. You pick the liquidity you want, you pick the risk level you want, and then you can find value everywhere. Well, can I push back on that? Because, I mean, let's just fold in all of this debt issuance that we're seeing surrounding the AI trade. Because that definitely seems to be competing to a certain extent with basically any other sort of fixed income asset right now. Is that something that will sort of right-size itself in due time? Or is this going to be a longer-term story where as long as these issuers are, I mean, they're coming to market with issues that are bigger than some of these treasury auctions? You are absolutely right. We are seeing a complete re-rating of how large our credit markets can get. Our public credit markets have always been large, but the private credit market got very large, and now you see a lot of crossover credit happening. You could argue where it's going to be sourced from. At some point, you get to a natural capacity limit of how much credit could be issued. But right now, they're all re-rating. And they're re-rating because you have these borrowers who have never borrowed before. So they are not leveraged. They're not under stress. And that's allowing the market to expand today. They will hit their natural limits. And like any credit cycle, you will see stress. But that is not for today.
Talk about those limits, though, and kind of when Principal expects to hit exposure limits to single names, to names that haven't been raising and now suddenly are raising billions.
Our view is in certain parts of the economy, you are at that limit. You know, there's a lot of talk about AI, and AI is not just a credit issue or a stock issue. It's an economy issue. And there are parts of this economy that are going to get resized because of the AI effect. And so from our seat, you have to look at credit in the context of where the economy for that particular sector is getting resized. What might have looked well 10 years ago doesn't make sense now from a limit. And we have to constantly think about the flywheel effect of economy changing, how credit markets have to readjust to it to come with the right exposure limits. Well, as you sort of look at that, and you sort of have people looking at their portfolios and wondering sort of where the balance is. I mean, we're obviously way beyond the 60-40. I don't know what the breakdown is. But do you add exposure to that now, assuming you don't have much? Or even if you have much, do you add to that exposure? Our thinking has evolved beyond just sort of the 60-40 stock-bond mix to have a little bit more total portfolio approach and to think in terms of liquidity, think in terms of the income structure of the market, and then obviously think in terms of the economic change of the DNA of countries and society. I would say, Romain, today, if you ask me to think where the markets are certainly looking forward, I would make a prediction here to say, in the long term, because of what's happening because of AI, public market equity investors will certainly see more value in front of them. And in the private markets, real estate and infrastructure investors will see the biggest value creation. that's how you have to think about asset allocation, where value creation is going to happen. And then you have to be extremely smart to know that you don't bind yourself to a certain bond portfolio or a certain private credit portfolio, because this is a fast-moving transformation ahead of us.
All right, Kamal, always great to have you. Always
Absolutely.
Smart. Kamal Bhatia, CEO and President of Principal Asset Management, kicking us off to the close here on this Monday afternoon with the big focus on the so-called debasement trade. Gold continues to move higher, and so too does crypto. We're going to catch up with Tether co-founder Bill Quigley in just a second.
Plus, from Bitcoin to Bilt, the rewards platform beefing up its strategy with an Equinox partnership. We'll sit down live with Bilt CEO and the Equinox executive chairman, Harvey Spevak.
And Scott Bessent had the spotlight today, but it's going to be Kevin Warsh later in the week. We're going to catch up with Torsten Slok, the chief economist over at Apollo, to get his thoughts here on whether the two are working together or maybe working against each other. All that and more coming up in a bit, right here on The Close, right here on Bloomberg. Welcome back to The Close. Bessent's Treasury twists fueling the so-called debasement trade, including in cryptocurrencies. Bitcoin rallied 23% last week, and we saw $3 billion flowing into a lot of those spot crypto ETFs. There's a lot of questions about what Bessent might do next, but most people are pretty confident that it would involve something on the short end of the Treasury curve, and that actually could act as a tailwind for the crypto space and certainly the stablecoin space as well. Bill Quigley joins us right now, co-founder of Tether and Wax. And Bill, that's where I want to start off here with this idea of how much of some of these moves that we've seen over the last couple of weeks in crypto is directly correlated to some of the concerns regarding what's happening at the Treasury and the current fiscal situation in Washington.
Well, what I would say is Bitcoin had been, for most of its history, uncorrelated to gold, really uncorrelated to any traded asset, S&P 500 and so forth. Recently, it's gotten as high as 0.71 to gold. So it's starting to look a little bit more like a gold-type hedge against Treasury, U.S. government inflation sort of a play. I don't have a lot of conviction it'll maintain that close association, but that's what's probably driven it up from its June lows of, let's say, 58,000. It's up about 35% since then. A lot of that has come in the last week or so, but Bitcoin people all around are certainly happy about that.
I am curious about how stablecoins factor in, particularly given Scott Bessent's focus on issuing more shorter-term debt in terms of T-bills that a lot of these stablecoin issues want to get their hands on. This is a relatively new buyer to the market relative to what we would have had a few years ago. Is that going to be material?
I think so. I mean, look, the way stablecoin issuers make money is they invest their collateral, which is usually U.S. dollars, into very short-term and very liquid assets, U.S. government bonds being an obvious one. Tether has $115 billion in government bonds. So any movement, a few basis points movement, when you're talking about those huge numbers, have a very sizable effect on the profitability of these companies. A public company like Circle, the vast majority of its profit comes strictly from earning money on the balances of its stablecoin that it's investing. So yeah, they're very much sensitive to whatever the Treasury is doing.
So, Bill, when you think about just kind of where the digital asset market is headed, if so much of the recent rally kind of has been around the so-called debasement trade, do you see a point where fundamentals come back into play, where all of those institutional investors that maybe exited earlier in the year finally do come back?
Possibly. Having said that, when we look at what would drive prices of Bitcoin and other cryptos higher, you've got to look at just where the big piles of money sit. So things like the big wealth management companies on Wall Street, how much are they telling their customers to hold a certain percent of Bitcoin? That's actually pulled back a bit from what it was a year ago, or even more when ETFs became available for crypto. So I would say right now, the market is sort of sitting tight. The giant sources of capital, 401k inflows, those things are not moving as much as what I would like to see. There's been a lot more money in the last year that's gone into gold ETFs versus Bitcoin. I suppose you can take some comfort in that if you're a Bitcoin holder and say, well, there's a lot of dry powder that hasn't yet been deployed. So when that does happen, Bitcoin should go up by a great amount. But the market sort of got to its 100 billion of Bitcoin AUM in the ETFs and then paused. And so now it's a matter of probably processing through what the market thinks about Bitcoin and the other cryptos and the effect of the Clarity Act, the big legislation that's been put forth in Congress, that's going to cause a lot more people and a lot more companies to be involved in the crypto space.
Right. Well, speaking of people involved in the crypto space, I mean, Bill, I know you've been in stablecoins for some time. The meeting at Jackson Hole of central bankers this week, the topic is financial innovation, implications for payments and policy. Any thoughts or expectations on what we'll hear out of the central bankers?
I don't think we'll get any real news, though I would say the U.S. has become much more clear with stablecoin issuers and with all tokenized assets with respect to the Clarity Act. And if we had the Genius Act last year that laid out what the rules are for launching a stablecoin, the Clarity Act provides a massive amount of market infrastructure policy work towards other things, all tokenization of other assets globally. So these people at Jackson Hole, they have to be thinking about this. The estimates are that today we have about 20 trillion of tokenized assets. And by 2030, I think Citicorp thought it would be about 5 trillion. So they have to get their arms around this.
All right, Bill, always appreciate it. Bill Quigley, co-founder there of Tether and Wax, as we continue to look at Bitcoin now flirting back with that 80,000 level. Meanwhile, also having a relatively good day and quite frankly, a relatively good few weeks. Some of those beaten down software stocks. We're going to talk about the state of that so-called SaaS apocalypse with Gabriela Borges over at Goldman Sachs when we come back after the break, right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off with Canada Goose. Wells Fargo downgrading to underweight, citing tariff pressures and the risk of a warmer winter that might actually cut into sales. The share is now at their lowest level since May of last year. Next up, Jersey Mike's. Morgan Stanley joining a wave of initiations on the stock today, an overweight and a $29 price target, with the firm saying Jersey Mike's has a long-standing share taker in the industry with a reasonably durable business. Share is not too durable, though, down about 2.3%. And finally, Whirlpool. Wells Fargo starting coverage of the home appliance maker with an equal weight and a $42 price target. The firm citing the company's domestic footprint, giving it a distinct advantage versus peers who are more exposed to the tariff situation. Nevertheless, the share is down for a second day here, and those are some of our top calls. We want to go to one of the gainers on the day, and that is Salesforce. In fact, the stock rallying more than 37% over the last 2 months alone. A lot of questions right now heading into its big earnings report and just how confident investors are that it will survive the so-called SaaS apocalypse. Gabriela Borges joins us right now, U.S. software equity research analyst over at Goldman Sachs Research. Gabriela, great to see you.
Pleasure to be here.
Let's talk about this earnings report. I mean, the last one kind of surprised to the upside. Agentforce does seem to be maybe starting to take hold a little bit. Are we going to start to see that show up on the bottom line anytime soon?
We've been talking about the heavy lifting that a SaaS leader has to do to become an AI leader. Step one is you need to clean up your technical debt. Step two, you probably should be innovating either organically or inorganically, and we certainly see the inorganic piece of that with the announced acquisition of Fin. And third, you actually have to figure out how to monetize. So Salesforce doing things like AELAs, enterprise license agreements that include the AI functionality. That all puts it together really nicely. Salesforce started this heavy lifting in 2024. There is a fair amount of work still to do, but at least the company is recognizing, hey, this is wartime. We have a bunch more competition than we had in this market before. Let's do something about it to earn our place in the agentic stack.
So do you think for Salesforce and maybe for the software sector more broadly, the worst of the so-called SaaS apocalypse is behind us?
There's one thing that we still have to see, and we're starting to see it on more of the infrastructure side, names like Snowflake or Datadog, where it's becoming more obvious that AI is accretive to the growth algorithm. So for some of the names, especially the ones that have rallied off the lows in the last 2 to 4 weeks, one of the debates we're having is how do you take a bounce and turn it into a durable rally? Well, Salesforce has to prove that AI is actually accretive to its growth algorithm. Companies talked about acceleration beginning in 3Q organically. We'll see just what that pace of acceleration looks like. The more convincing the acceleration is, the more we'll be able to step back and say, AI is a good thing for this company. It's actually a tailwind.
Well, I'm curious. I did remember, I don't know if it was your report, but it definitely came from Goldman, and it was about the idea that this actually expands. So a certain AI expands the addressable market. Was that you? Is that what you're smiling? Okay, I always get confused. But talk to me a little bit more about exactly where that expansion is. Is that sort of at the security level, the orchestration level, the data level, where?
Absolutely. Yeah. So if you think about the front office stack today specific to sales and marketing, you can apply this analogy to any of the software verticals. If you're driving value for your customer, what does that mean? It means they're getting more productivity out of their day. The efficient frontier of what any one of the knowledge workers can accomplish gets pushed out. Companies have shown time and time again, and we saw this particularly in the digital revolution, anywhere through the 80s, through the 2010s. When software companies drive more value for their customers, they typically capture 10 to 25% of the value they create. And so our view is, look, you're starting to see very early use cases, coding, customer experience, that AI is actually additive to the value that is in the technology stack. Well, we think it's a matter of time before software companies, provided they have a differentiated product, are actually able to exercise some pricing power and capture some of that.
Just in the last minute here, we also have CrowdStrike earnings coming up. What are you watching out of that company?
Absolutely. So there is a view that AI is the next wave of digital transformation. And if that's the case, well, we need more security to protect that phase of digital transformation. CrowdStrike has done an incredible job of finding the right next-gen acquisitions to be able to scale into their install base and innovating organically. They have a very clean back-end tech stack. And so all of this leads themselves really well to going to customers and saying, we will be your strategic security partner, not just today, but 3 years from now. We don't know exactly what the AI roadmap will look like, but you can trust us as your security partner to figure that out. That tends to lead to bigger deals. That tends to lead in a more strategic relationship. All of that is a good thing for CrowdStrike's positioning in the enterprise.
Gabriela, great stuff. Got to get you back. Gabriela Borges, U.S. Software Equity Research Analyst over at Goldman Sachs Research. Now, when we come back, we're going to talk about Bilt and its partnership with Equinox. We're going to talk with the CEO of Bilt and the executive chairman over at Equinox, Harvey Spevak. This is Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Emily Grafeo.
All right, Emily, let's talk about a recent tie-up in the consumer realm. Membership and hospitality platform Bilt launching an exclusive partnership with the luxury fitness brand Equinox. You might have heard of them, right?
Yeah.
You've been there, right?
I've seen a couple. I've smelled the eucalyptus.
It smells great in there. The move is aimed at connecting the two brands' audiences with benefits like redeeming Bilt cash for credits that can be used towards Equinox experiences. Pleased to say, joining us here in Studio 2 is the CEO of Bilt, Ankur, Jain, and Equinox Group Executive Chairman Harvey Spevak. Great to have both of you back here on the program.
I mean, this is great. It's our first time doing this together. This will be fun.
It will be fun. Thanks for having us.
Well, I know how great Equinox smells on the inside. What does Bilt smell like now? No, in all seriousness, talk to me.
By the way, in every move-in at a Bilt apartment building, we should probably give you an Equinox eucalyptus towel as a move-in gift.
You can smell them on the street. Walking by an Equinox, there's an Equinox
near. Now. I'm good.
It's better than the Abercrombie smell in high school.
Wow. All right. Well, there you go. All right. Let's start. Let's get serious now. But I am curious, though, Ankur. I mean, we talk about the partnerships you have. Obviously, apartment buildings, airlines, hotels, restaurants. Why gyms?
I mean, look.
Yeah.
Bilt today represents 1 in 4 apartment buildings across the United States. And when you move into a new home, you're resetting some of the most important lifestyle decisions that you have. It's what's your new pharmacy? What's your favorite go-to restaurant and bar? Where do you park your car? And one of the biggest decisions everyone makes is, what's my new gym? And so when we thought about what's the gym that we want our members to connect to and have our concierge be able to coordinate your training sessions, your spa, your workout classes, I mean, there's really no place better than Equinox.
I certainly understand what you get out of the partnership with Equinox. Harvey, I'm going to kind of pose the same question to you because I've always looked at Equinox as being one of those companies that really guards their brand. You don't necessarily get into business with just anyone. What attracted you to Bilt, and how does that enhance your brand?
So I appreciate that. We are very selective, and Ankur and I have been good friends for a long time, and so I've watched Bilt grow up the way they have and have exploded in more recent times. And we just felt there was a natural evolution of us coming together, part because of the community that he has so successfully built around the country, and part because of our community. So, when we've looked at it, there's overlap between our two existing communities, but our community wants more from us, and his community wants more, particularly from a neighbor perspective. And so we've always focused on helping our members live a high-performance lifestyle. We do that by helping them thrive and perform and grow. And so this was just a natural evolution for how we can serve our community better.
You have a good view on the consumer. You're seeing kind of what the Bilt members are using their rewards on. How would you say the state of the consumer is right now, just given where people are choosing to spend their member rewards?
It's funny, we were talking about this the other day. Historically, people would save up rewards and do these big, lavish trips. You would save up for a year and you would go do that summer trip to Europe. This year, we've actually noticed a little bit of a shift, which is people are craving these micro experiences on a daily basis. So if you look at whether it's the comedy shows that we host around the country, these fitness classes, actually one of the reasons we started this conversation, our partnership actually started a few years ago with SoulCycle, which is owned by Equinox. And it was unbelievable how often we were seeing members redeem their points to book a SoulCycle class, because that 45-minute local micro experience was something that was like that micro luxury you could have in your everyday life. And so to scale that now to the entire wellness journey, from the spa, the personal training, the juice bar at the Equinox, to just going in every day and being able to check in with one click, I think it's a pretty natural synergy in how you think about your life.
But can I ask you just about the economics of this? I mean, who's funding that? Is it Bilt? Is it Equinox? Or is that kind of coming out of the rent payments? Where?
So Bilt members earn rewards every day, both on their rent and mortgage payments that they make, and also in the neighborhood ecosystem, right? And so when you think about local commerce, there have been businesses like Yelp, there are businesses like Facebook ads, OpenTable, Toast, DoorDash. Businesses are constantly looking for new ways to reach customers and bring them in. And through this rewards program, they can target the specific people who are high value, living down the street. And as they fund those rewards to bring them in, those rewards are now backed by cash that they can then come and spend at places like Equinox. And so when you come in and say, God, I'd really love that micro luxury experience of a massage that I deserve, which maybe I should probably book one with my points after this interview, but like, you go in and you can now use those points and we can fund that back to Equinox as a full redemption.
But I would just say, to add to that, I mean, there's joint funding here. So we want, through our ecosystem, we want more engagement. Ankur, and Bilt want their more engagement. So we're both supporting the respective communities to come together, but also to engage in a healthy lifestyle.
So Harvey, how do you kind of see it playing out for Equinox? Is this a partnership that's you anticipate it'll bring in new Equinox members, or this is existing Equinox members maybe, linking their Bilt account?
It's a combination of both. I mean, we're always looking for ways. I mean, Ankur used the bad word. He used the word gyms, which is a four-letter word to us. We use the word clubs because we've always defined Equinox in this category one. So we're always looking for ways to serve our existing community as a first priority better. And this partnership allows for that. As mentioned earlier, I mean, we're very, very selective of who we'll partner with. But then there's, of course, we're in growth mode. We're opening a lot of locations. We have a pipeline of almost 50 new locations around the U.S. and new and existing markets over the next 4 to 5 years. And so the ability to acquire more members and bring more people into our community is an important part of this also.
I do want to ask you about specifically the Equinox business overall, and particularly the types of clients that it's serving, and whether some of the trends that we're seeing now overall out there with a lot more focus on longevity and just being healthier, not just amongst older people, but even amongst younger people. Has that had a material impact on your business?
Oh, absolutely. So, I kind of call it HWL, health, wellness, and longevity. And so people used to be people as they got older, they would start thinking about, okay, how do I focus on what now we refer to as my health span, not just my lifespan. What's happening now is younger people are thinking about it, particularly women. They're thinking in their 20s, what do I need to do now So as I get older, I can live a healthier lifestyle. So it's a big part of what's supporting us. And the best stat is the average Equinox member checks in more today than ever before. So there's a higher level engagement, and our partnership with Bilt will even stimulate further.
But we should talk about that. This is a fun one. If you are a Bilt member and an Equinox member, we're actually running a fun campaign. This is about commitment, right? And if you're into fitness and wellness and health, we call it Bilt for the committed. But every time you check into Equinox, every day you get entered now to have your rent or mortgage payment and a month of Equinox membership covered, because we want to celebrate that culture of commitment. And so that's a really fun one that we just launched.
We're going to let him fund that one.
All right. Well, speaking of funding, I do have to ask you I'll let you go, Ankur. I mean, you raised, a lot of money just about a year ago. What's next? Are you going for another funding round? Are you thinking about an IPO?
I mean, listen, we are focused right now on the scale of our neighborhood ecosystem. And so I think a lot of people know us for our membership program, which is now 7 million members a month using this platform. But the other part of our business, which is our neighborhood operating system, which is allowing local businesses to both manage their existing customer experiences and connect to the neighborhood commerce ecosystem, like what we're doing here, is growing so much faster than I ever would have thought. And so, candidly, I think we have a long way to go of just keep our heads down and focus on growth before I start worrying about IPO and doing that type of stuff.
All right, that was a good non-answer.
Yeah.
I appreciate you. You're well trained. Ankur, great to have you here.
Good to see you guys.
Ankur, Jain, of course, the CEO of Bilt, and our thanks as well to Harvey Spevak, the executive chairman over at Equinox. All right, coming up here, we're going to talk about the breakdown in those U.S.-Canada trade talks and the impact it's having on a lot of stocks out there, including Ford and GM. We'll be back in a moment. This is Bloomberg. Time now for our stock of the hour, and we're taking a closer look at shares of Ford and GM, the two big U.S. auto companies, along with some of their Canadian counterparts like AutoCanada, under pressure after a breakdown in those U.S.-Canada trade talks. President Donald Trump saying that he will double the tariffs on cars coming out of Canada, as well as car parts starting at the top of the year. That would take the tariff rate from 25% to 50%. David Welch joins us right now, Bloomberg News Detroit Bureau Chief. And David, just to put a finer point in this, because I went back and looked at some of the reporting by you and your team. Last year, Ford and GM basically got hit pretty hard. I mean, they took a pretty big hit just from a 25% tariff out there. Is there any sense here, I know we're still a long way from January, but is there any sense here that anything will be able to be negotiated to avoid that going up to 50%?
Knowing how the Trump administration has worked on this, if they're not getting something that they want, they go with a really big number and they set a deadline on it. And those deadlines often move. But you're talking about 4 months here. And the car companies, they're doing double time now, trying to come up with ideas, suggestions, lobby for things that can help lower these tariffs. And head off that 50%. That January 1st date is now kind of marked on every auto lobbyist calendar as something they need to try to avoid, a 50% tariff coming out of Canada. And look what you have up there. You have heavy-duty pickup trucks and medium-duty pickup trucks made by Ford. That would be a big hit for them. Toyota makes a lot of vehicles up there. GM makes truck engines in St. Catharines, Ontario. These are all big ticket items that would hurt them quite a bit. And they're moving to avoid that. And look, just a week ago, they thought they were going to get these tariffs from 25% to 15%. And here we are moving in the other direction because everything broke down.
Okay, David, so besides maybe lobbying to delay the tariffs, what else realistically can these automakers do in the interim?
I mean, there's not a lot. You can't move production in a big way in 6 months or even 12 months. I mean, look at General Motors moved some production back from Mexico, Chevy Equinox, Chevy Blazer, to the U.S. And that's going to happen 2027, 2028. And they announced it, I think last year. So it takes a couple years, even when you're moving an existing vehicle to a plant that exists, to get the tooling and get people hired and get those plants going. So it takes a lot of time. They can try to find some parts. They can, maybe find some new parts sourcing here to avoid it. But, look, GM, they were saying that they were going to have a tariff hit as much as $5 billion. They thought they could offset about $2 billion of it. Now the tariff hit is $2 to $3 billion, I think, and they've had to work to do that, and that's by relocating production, relocating parts, finding other offsets, lobbying for offsets. So Trump did give in on not putting tariffs on some of the U.S. content coming out of some of these places. They lowered some of the original tariffs on Asian imports. So there's been some leeway given by the Trump administration that has brought that burden down, but it's still a lot of money that they have to pay in tariffs.
All right, absolutely. David Welch there, our Detroit bureau chief, and just looking at those numbers, once again, Emily, it was a $5 billion hit to operating profit in 2025. That was just off that 25% tariff. So it'll be interesting to see if this does take effect in 2027, what that actually does for their profitability and sales. Meanwhile, we keep an eye on the broader market here in the U.S. We are in the red pretty much across the screen. We're going to catch up with Mimi Duff when we come back after the break, Senior Client Advisor over at GenTrust, right here on Bloomberg. Just about 10 minutes until the closing bells here on this Monday afternoon. I'm Romaine Bostic.
And I'm Emily Griffeo, and we're joined here on a day when the equity markets are lower, Romaine, and this is all ahead of that key earnings report on Wednesday. We thought earnings were over. They're not yet.
No, in fact, it's we saved the biggest for the last, I guess. The biggest company out there, Nvidia, which is kind of interesting, too, because it's kind of heading into this vacuum where it's basically going to be the only thing everyone's paying attention to, at least when it comes to equities. And then it's kind of sandwiched in between some of these macro issues going on with whatever Scott Bessent's doing over at the Treasury. And then, of course, Kevin Warsh with the big speech scheduled for Friday morning at Jackson Hole, Wyoming.
Yeah, I mean, Warsh is heading into that meeting. With yields elevated, we do have those long end yields actually moving lower today, but still, I mean, the 30-year-old above 5.2%, something to watch. And the debasement trade is back in play, Romaine. We have Bitcoin up higher while stocks are lower. I also just want to flag those chip stocks. The Sachs index is down almost 3%. And again, this is a week when we're headed into Nvidia earnings. There's a lot of eyes on that AI, that semi trade. The read right now from Wall Street is we don't want to own these chips any longer.
Yeah, a bit of a rotation trade out of some of those chip names. The Sachs now down about 24% from its all-time high back in late June. Mimi Duff joins us right now here in Studio 2, Senior Client Advisor and head of the New York office over at GenTrust. And Mimi, I do want to start with the chip trade because we are going to hear from, well, the biggest and most consequential chip maker out there on Wednesday afternoon. And I know you can't talk specifically about Nvidia itself, but when you look at some of the rotation that we've seen out of chips, but not necessarily out of the AI trade writ large, what does that tell you?
Yeah, I think some of this pullback right now could just be risk reductions ahead of a big event on Wednesday. We've got some, as you said, some big macro events too. Broader speaking, the earnings beats have been tremendous. Even taking out the one-off markups, you still have had really solid beats, something like 86% versus a 5-year average of 75% on earnings beats. So that's been very strong. And I think that that's the big picture macro at play right here.
Well, I am curious, too, when we talk about this earnings season, I was looking at the numbers earlier. For the S&P 500 in aggregate, we're talking about 15% EPS growth. That's about 2 percentage points higher than what the expectation were. Revenue, 30+%. And that was like 10 percentage points higher than that. And even if you sort of graded on the curve to kind of X out maybe some of the high-flying chip names, it was still a relatively broad-based earnings growth out there. Does that give you hope for the rest of the year with regards to what we're going to hear from these companies?
Well, I think so. Yeah, I mean, I think you're really hard-pressed to find the bad news there. If you're looking for bad news, you can look in the inflation situation. The past couple months have been a little bit better behaved. We have PCE this week. You want bad news, you can look at the debt markets, higher yields. We have had corporate issuance. One stat I saw on a duration adjusted basis up 35% year over year. So not just more treasury issuance, but corporate issuance has been stronger this year too. So there's more paper to digest. But I think the equity earnings story thus far has been a good one.
Okay, well, you talk about the paper being issued. A lot of these hyperscalers are coming out, they're issuing bonds. They've never been in this market before. How are you guys handling all of that debt?
Yeah, so we are not, on the hyperscaler side, I think I saw a stat up 80% year over year in that segment of debt issuance. Within interest rate products and debt, we are underweight credit right now because credit spreads are near 27-year tights. We just don't really think you're getting compensated as a taxable investor to own much of that debt. It's not where we're focused right now.
Okay, you also mentioned PCE. You have one hike priced in by the end of the year in your notes. Do you think that a soft PCE would maybe change that, or you're sticking to it?
Well, that's not our view. That's the market's view, which has something like 60% priced in by October and almost 2 by the end of next year. And these things are flying around as we're seeing new data come in. I think that if we get another really well-behaved print, maybe they'll want to hold off in September, but then it puts October in play. I mean, these prints have been over the 2% target for more than 5 years, right? We can't pretend we don't have an inflation problem right now. We do.
Well, let's talk about that inflation problem, because that's all anyone seems to want to talk about. And we look at the movements that we've seen in the bond market over the last few days, really the last few weeks. And now a lot of people looking for alternatives, if you will. We've seen a huge rally in gold and other sort of physical assets, Bitcoin as well. Do you recommend maybe allocating a little bit more to some of those areas given what's going on with yields?
Yeah. So this dollar debasement theme, if Treasury does buy significant paper or rotate, issue more bills and take more of the age securities out, that's a dollar weaker trade. We do have in our core portfolios allocations to real assets. That's REITs, that's energy producers, that's gold. We happen to have uranium too. That basket's up very heartily this year, more than 30% in our basket. We do recommend keeping hold of those types of assets. Also on the equity side, non-US equities. We hold those in an unhedged way, and those have also beaten the S&P this year as well as last year, but there's been a continuation
with
there.
the non-U.S. equities. Are there specific regions that you're in favor of?
Well, the ones that have performed the best is the Pacific region, has done very well with Japan, Korea, and it's got some good diversification there, but we also have Europe and the other non-U.S. sectors.
Not too many guests come on and talk about uranium, Mimi. Gotta say.
Yeah, well, that's a bold call, but no, I mean, we've heard from a few other people on that. And just real quickly before we let you go, I am just curious about the Japan angle too, because there's been a lot of discussion about the competition now in terms of assets and returns and what investors are looking for. You've already started to see that in the debt markets, Japan versus U.S. And there's 2 big debt sales coming up next week in Japan that a lot of people are focused on that think could maybe exacerbate that.
Yeah, I mean, it's certainly a theme, right? Their currency there has, it's 40-year low or whatever the stat is, and they've made it clear that they would like to lift their currency. Our Treasury has been helping them facilitate some activity in the market there. I think Japan right now and Asia in general is a bigger player in some of the macro themes that we're seeing.
All right, Mimi, always great to have you here on the program. Mimi Duff is Senior Client Advisor and Head of the New York office over at GenTrust, counting us down to the closing bells with the S&P 500 marginally in the red on the day, despite the fact, Emily, the majority of the stocks are in the green, just not the ones that we would normally sort of champion.
Yeah, I mean, that chip trade really falling off, as we just spoke about with Mimi, and the NASDAQ 100 also lower. What's holding up? It's Bitcoin, Romaine.
All right, we are moving closer to those closing bells. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Emily Grafeo, taking you through to that closing bell. It's a global simulcast. Tim Stenevec, he joins us from the radio booth. Nora Melinda in today for Carol Massar. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, with stocks on the back foot. To start a week, Tim Stenevec, that historically would be a little bit of a snoozer. I mean, it's the last week of August, and there's a lot going on.
It is. There is a lot going on. I mean, we got Friday, and we got the Jackson Hole Economic Symposium. I hear Mike McKee's already out there, and I guess Tom and Lisa are going to be on their way pretty soon. But before that, we have Nvidia reporting. We'll get that on Wednesday. Did I hear Emily talking about Bitcoin just now?
I made a little plug to Bitcoin.
Okay.
I mean, listen.
Yeah, up another 1.8% today, right?
When you're up like 2% on a day when other risk assets are down.
Well, especially if you're Bitcoin and you've been in the 60s and you're getting close to 80.
Exactly.
Yeah. Thank you, Emily.
You know, you're talking about how busy this week is. We've got, as you mentioned, Jackson Hole at the end of the week and Nvidia in focus, but also PCE. We're going to be getting that on Wednesday as we still continue to watch and monitor inflation. And we know that PCE is the Fed's preferred measure. So maybe that might perhaps be a tee up for what Kevin Warsh is going to say on Friday to an extent.
Yeah, kind of a weird week here because, you know, most people would be away. And we should point out volume in the equity market is light, about 20% below the average at this time. But of course, that could change in a big way, particularly on Wednesday with that PCE data in the morning, Nvidia earnings after the bell. And then, of course, everyone's still awaiting Kevin Warsh at the end of the week. We get the closing bells to start the week. And you actually saw a little bit of a bid come back into this market as we got closer to those closing bells, particularly when it comes to the Dow Jones Industrial Average. It had spent a good portion of the session in the red, but we did see a little bit of a spike into the close. Now up about 140 points or 0.3%. The S&P 500 is lower by 21 points or 0.3%. The NASDAQ Composite down about 0.8%. The NASDAQ 100 down 1%. And the Russell 2000 closing out the day down about 0.8%.
In the S&P 500, peeling back the layers, you actually saw significantly more stocks move higher in the S&P today, more than 300 to the upside, fewer than 200 to the downside. Kind of speaks, Emily, to what the actual stocks that were moving in there and, you know, the weight of them.
Yeah, definitely information technology. The big loser here, at least on the day's trade. When you take a look at the S&P 500 IMAP function, you can see that red, mostly IT, but also energies and industrial lower. But there were actually more sector levels in the green today, leading the way consumer staples, financials, and utilities.
Well, let's get to some of the stocks that moved higher today. I want to start with an online travel agency, Expedia Group, best performer in the S&P 500 today, reaching a new intraday high, up 5.4%. This after we heard from Evercore ISI's Mark Mahaney, who lifted the price target on the company to a street high of $430 from $375. He maintains his outperform rating. He said that Expedia has the most attractive valuation on a price to earnings and free cash flow relative to Airbnb and Booking, a couple of its peers. Once again, shares of Expedia up more than 5.4%, reaching a new high in the S&P 500 today. Also, I don't know if you guys seen the new Spider-Man movie. Have you seen?
Oh, yeah.
You have seen it? What about the Odyssey?
No.
Anyone?
Have yet to go.
Romaine, did you see the Odyssey yet?
I have not seen the Odyssey yet. I'm waiting for it to come out on DVD.
I'm waiting for it to watch it on a plane.
Yeah.
Just how Nolan would want someone to watch it, right? On the back of a seat. Well, it's still sending shares of IMAX and Cinemark Holdings higher today, but it's more about Spider-Man. Over at B. Riley, Drew Crum said that this weekend's gains were solid. We saw IMAX shares move higher by 3.9%, Cinemark up close to 5%. Spider-Man Brand New Day brought in over the domestic box office close to $130 million. That was up 64% year over year. Excuse me, that was just the box office, not just that one film. The Odyssey did bring in more than $19 million over the weekend. I was going to go see it, and then I found out how long it was, and I decided, you know, we're going to go get dinner instead. So we didn't do both of those things. Finally, watching the Spider Gold ETF. GLD is the ticker. This as gold. It continues its run higher, up 0.8% today, climbing to the highest in more than 3 months. The U.S. Treasury's intervention in the bond market, reviving some concerns about fiscal policy and its impact on the dollar. The Spider Gold Trust today higher by just about 0.8%. Gold hovering around $46.80 an ounce.
Well, there's quite a few decliners that we can look at this afternoon. So I'm looking at shares of Nvidia, SanDisk, Micron, as you keep an eye on some of those memory chip makers there. So Nvidia down, actually seeing its worst streak since 2022, that's September, down for a 7th straight day when we look at the losing streak. And essentially some of Nvidia's biggest customers, we're told prices for certain AI servers are going above 15%. So you saw that not only weighing on SanDisk, but also Micron. And all of this really in the lead up as we keep our eyes on Nvidia earnings that are due after the closing bell on Wednesday. But a big story today was also tariffs, of course, between the U.S. and Canada. And we did see a double downgrade on Canada Goose. That's a name that I'm watching. The stock falling about 5% on the day for two reasons primarily. That double downgrade to underweight from overweight at Wells Fargo. And the two things that the analysts are pointing out is, one, the tariffs, as I mentioned. They're essentially thinking that the company should be facing more macro risks, like the 50% tariffs that the U.S. put on Canada. But separate to that, warmer weather and El Nino continuing to be in focus. When we take a look at this company and others, maybe people aren't actually going to be rushing to get a parka if it's not as cold of a winter as we've seen in the past. And lastly, looking at Hims & Hers Health, this is a stock that we continue to keep our eyes on, down about 8% at the closing bell. We were talking about this earlier with our very own Avalon Purnell, and essentially we're learning that Visa put the company on notice for the fact that it was getting excessive customer complaints, credit card disputes. This is because all these customers were upset about its weight loss subscription. Starts out at a $39 intro membership and actually jumps to $149 after that. And this is all not including the drug cost there. So you saw that weighing on shares of Hims & Hers.
All right, let's take a quick look at yields, basically down across the curve. The 2-year basically unchanged on the day, but bigger moves on the longer end of the curve with the 20 and 30-year yield down about 4 basis points, continuing this little seesaw back and forth as bond traders and options traders, more importantly, try to get a handle on where they think yields might go next. I do want to just bring this to your attention, Tim Senovic. You are a father of multiple offspring.
I am.
I don't know if you have enrolled them in any of these elite private schools, but good news for you.
Okay.
We're actually starting to see more financial aid packages, despite the fact that a lot of the people sending their kids to these schools, in theory, would actually just have the cash to pay out themselves. We're basically talking about people who maybe make, households, I should say, that make as much as $500,000 a year, now being offered basically, some way to sort of subsidize that education. And that's largely because a lot of these private schools, they're struggling to kind of hit their intro targets.
Well, it could be because tuition has gone up so much at these schools. I mean, we're talking for boarding schools, like Deerfield, for example, upwards of $80,000 a year. Even day schools, $50,000 a year, Emily. But look, I mean, there are plenty of parents who can afford to pay full freight at these places, and we'll actually stop at nothing to kind of pay as much as they could for an excellent education, which many people argue these schools offer.
Yeah, but I mean, it's all
and
coming.
An experience too.
Yes, of course, the experience of being at boarding school at the ripe age of 15. I mean, it is coming.
What's the experience for the parents who have to pay all this money? Just asking for a friend.
Oh, kid.
Question that needs answers.
Yeah. Okay.
Quiet. The cost of living is going up, though. This is something that I do want to point out. Our very own Aaron Hudson, writing this article and pointing out that investment advisor Smart Asset now estimates a family of 4 needs roughly $200K a year to live comfortably in San Antonio or New Orleans. In New York, that figure rises to almost $340,000. So, I mean, right, like a tuition of $80K, that's really going to knock out a lot of your budget.
And what's interesting is in the story that Erin Hudson wrote, she essentially says that the schools are calling these parents middle class. So it just really shows you where we are economically. But separate from that, the fact that many earn far more than roughly $84,000 in terms of the median income. But it's $150,000 to about $500,000 that can qualify for that help.
Okay. Don't worry, the cost will continue to go up. My kids are too young now to be thinking about this, but for us to be thinking about it. Yeah, maybe we can talk about college another day, too. That is going to do it for our cross-platform coverage of the market close. Did you write those checks yet to the colleges, Romaine?
Don't start, my friend. I'm already looking like 4 or 5 years down the road when all that disposable income will be coming back my way.
Yeah. What about grad school?
Oh, no.
Okay.
He's on his own.
He's on his own. All right. We are not on our own tomorrow when we are going to join you guys, same time, same place, for some more of our cross-platform coverage. It is Bloomberg.
And our coverage continues here on Bloomberg Television. When we come back, a breakdown of the economic cross-currents that U.S. investors are staring down. A conversation up ahead with Torsten Slok, chief economist over at Apollo. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick. A low-volume day in equity markets with most of the major indices finishing the day in the red, fractionally so, but still the trend line has been much softer than what it was just a few weeks ago. A big part of the reason are the other lines on the screen behind me. A big focus right now on rates and a big focus right now on gold and the dollar. The dollar weakening on the day, and so too is the Canadian dollar, and we'll get to that in a second. But that gold, that spot gold number still continuing to creep back up right now at about 4.65 a troy ounce, raising a lot of questions here about just how much further this can go and whether this is indeed all tied to those concerns about inflation, the fiscal situation, and everything in between. Now, as far as that weakness that we saw in the Canadian dollar today, that came because of the big breakdown that we saw in the U.S. Canadian trade talks, a breakdown that led President Trump to say that he would actually boost tariffs on some Canadian goods, primarily autos, by double, 25% to 50% starting at the beginning of the year. That actually took a bite out of some of the U.S. automakers like Ford and GM. Meanwhile, that debasement trade and everything around it has continued to actually weigh on the AI sector. Some big concerns here heading into a big report by Nvidia. Of course, some people also trying to maybe cash out to maybe put that cash to other use. We'll get to that story in a second. And Visa having a pretty good day, up about 3%. Some of that a beneficiary of some of the moves that we've seen back and forth in the yield space. And that does bring us to our top story for the hour, the direct intervention by the Treasury to control the costs of the $40 trillion U.S. debt pile. The historical track record of such interventions are spotty. The two most recent successes. First, the Treasury's repurchase in the early 2000s of about $67 billion of primarily longer-dated bonds. It was a protracted operation that did actually push the 30-year yield down by about 2 percentage points, from 6.7 to 4.6 over about a 2-year stretch. And then second, there was Operation Twist in 2011. That was a duration management scheme where the Fed, not the Treasury, bought $400 billion of longer-term treasuries while selling an equal amount of short-term debt. Now, Besant's actions so far seem to be standalone independent, which is curious given that 2 years ago he blasted his predecessor at the Treasury, Janet Yellen, for what he characterized as an attempt to re-engineer the world's largest bond market. But it's also curious timing for all of this as Fed Chair Kevin Warsh preps for his own communications moment, a speech Friday at Jackson Hole, Wyoming, that ostensibly is supposed to be about some of the wonkier, more procedural matters out there. But no doubt there will be high attention as to whether Warsh is willing to formally aid in Besant's intervention and whether he'll actually offer a more detailed explanation of the path for Fed rates. Torsten Slok, he joins us right now. He's the chief economist over at Apollo, and he joins us right now. And Torsten, I want to start first with Scott Bessent, what the Treasury is exactly trying to do and whether history might actually be at his side with regards to the potential effectiveness of some of this bond buying.
Well, the first thing is that it really is three things. He started with the yen intervention that was pushing long rates down. Then he had the FEMA intervention, the $2 billion went to $4 billion, which also has been pushing rates down. And today we heard some talk about, well, maybe the Treasury General Account will also be used to lower long-term interest rates. So there's almost campaign from the Treasury here in an attempt to try to put a cloud over rates markets that is attempting to try to limit how much rates can be going up. So on their own, these initiatives have had so far a more limited effect. But the fact that this cloud is hanging over the market, that suddenly something could happen, especially if the TGA, the Treasury General Account for the Treasury at the Fed's account at the Treasury's account at the Fed is being used, that could potentially have a bigger impact.
Well, when we talk about the bigger impact, though, I would assume the number, the dollar figure, has to get a little bit bigger than just 2 to 4 billion or whatever he said he might go up to here. I mean, is there a number that you look at where you think that A, would have an impact, but more importantly, a lasting impact?
Yeah, that's why today's news about the Treasury General Account, which really is the Treasury's checking account at the Federal Reserve, that has more than $900 billion in it at the moment. And that could potentially be a much bigger impact on the market because the threat of using as much as hundreds of billions of dollars on buying long rates could potentially have some implications. But that being said, a checking account always needs to be refilled with new issuance. So in that sense, it's really more the threat of this happening at some point that is having the biggest impact.
Well, that's what I'm curious about, too, is that would he even need to tap that? Because, I mean, I think back to when the ECB did something similar and they never actually made good on it because they didn't have to. It was just the idea that they said they would do it if necessary was enough to scare the market into sort of towing the line.
That's exactly right. So that's why it really ultimately is very similar to currency intervention from a central bank. If you say as a central bank that we may step in and do something, we may stay in and buy or sell our own currency, then that on its own could also be a very important factor when you then think about the risk that this as a headline could potentially begin to weigh, in this case, on rates and potentially suddenly create a drop in yields because of the Treasury deciding to do something. So that is probably shaking out some of the people who are now betting on rates moving higher.
But it gets to this idea, though, if we do get to a general account situation where they're either threatening to use it or actually use it, this goes far beyond debt management. I mean, and now we're I don't know what we call it. Is it? I mean, I don't want to use the QE word or the maybe it's just yield curve control. I mean, how would you characterize that if we do get to that stage?
Yeah, so the underlying dynamics are, of course, that rates are going higher because inflation has been higher, and the fiscal situation, unfortunately, has also putting upward pressure on rates. So therefore, those fundamental forces are still in place at the moment. So for that reason, these are certainly more, you could call, spotty interventions that are trying at certain points to limit how much rates are going up. But that being said, it's still a cloud hanging over the rates market that this could, now the third item coming along with the Treasury General account also now suddenly being in play. That also means that suddenly these things could suddenly jerk rates much lower. And because of that, that still is something that likely will begin to put some limit on how much rates can go up because you can suddenly be jolted down to a lower level.
Does it matter that, at least as of right now, this is the Treasury Department going alone and the Fed, at least based on what we know, is not actually involved in any of this? Do you think that would change?
Yeah, that does matter because at the moment, the Treasury, of course, is living under the condition that there is a budget deficit, which in round numbers is like 5-6% of GDP. That's not going to change. And if that's not changing, that means that there's still a need to finance the government deficit. And as a result of that, government debt levels are still going up. So in that sense, these things are all smaller things that are happening on the fringes because on their own, they're not changing the fundamental forces that are driving rates higher, namely at the moment higher inflation and also the fiscal situation.
Well, let's talk about some of those fundamental forces. I mean, obviously, we've talked a lot in this program, the near $40 trillion debt load, obviously the servicing load again. I was just looking at just the interest payments projected for Q4, and I think it was close to $200 billion. I mean, which is insane. So that's not something the Treasury can solve on its own. Certainly not even the Fed can solve on its own. That's something, in theory, that Congress would have to address. And as far as I know, it doesn't look like they're ready to do that.
Yeah, and the risk with interventions in any shape and form in lowering long rates is that if you issue more in the front end, that has two risks. First of all, it lowers the weighted average maturity of debt outstanding. That means that the weighted average maturity of what is the debt level in terms of duration, that will become lower. In other words, we will simply get that much more debt is now in the front end. And the second risk with that is that if much more debt in particular is in T-bills, that means that it becomes much more sensitive to what the Fed is doing because now a bigger share of debt outstanding is in the very, very front end of the yield curve. So if Kevin Morse decides to raise rates at one of the upcoming meetings, that means that debt interest payments will go up because there now is more sensitivity now that more debt is in T-bills.
Well, on that point, though, I mean, if the weighted average maturity goes down, I think right now it's around like 5.5, 5.7 or something like that.
Exactly.
And that's because of the shorter end stuff. Does that, I want to say by default, but does that put upward pressure on the average interest rate that we have on that debt overall?
Yeah, so it means that you certainly become more dependent in the front end because now you have more debt in the front end that then depends on what the Fed is doing.
Gotcha.
What happens in the long end becomes certainly a very important question around how does the long end interpret what's going on. If the long end says everything is great, no, we don't need to have high rates, we can now begin to go down, then you would have that the debt servicing costs would go lower. But if the long end begins to say, hey, we have some fundamental forces that are still at play and these have not changed, then of course the long end could go higher, and as a result the net effect would be you're both more sensitive to higher rates from the Fed in the front end, but you now also would see the term premium, we would see long rates go up because now the market is beginning to question either the Fed's commitment to 2% inflation or also the fiscal situation where now debt levels are still again continue to go up.
Do you have any expectation that Kevin Morse will address this in his Friday speech?
I think at Jackson Hole that he will probably be focusing more on the economic outlook. He'll probably be focusing more, if anything, on the framework that the Fed is having at the moment, just to try to address some of these criticisms that he has seen in terms of the last press conference, where a lot of people said, yes, we understand that forward guidance may be going away, but now instead we should be focusing on framework guidance. Tell us, what is the framework? Are you focusing on the balance sheet? Are you focusing on tightening financial conditions? Or are you focusing on the Fed funds rate? What are the tools you're going to use to tighten monetary policy to try to get inflation to come down?
You think he will do that? He seems like he does not want to be that communicative.
So that's why I think that most of the discussion will probably not be so much around the task forces. They probably don't want to preempt what they're going to deliver later this year, but it's probably going to focus more on what is the economic situation at the moment, and therefore less on the overall framework for communication, for the balance sheet, for data that he has in the task forces, but really more just laying out what is our view on the economic outlook at the moment without giving any forward guidance.
It was interesting looking at the last minutes and some of the anecdotal evidence that came out prior to that about a big focus on artificial intelligence and how it's affecting either productivity or inflation or vice versa, depending on your perspective. Do you think this will become much more of a dominant conversation, not only at the next Fed meeting, but for the next couple of Fed meetings?
Yes, I do think that this is becoming very important exactly for the reasons you're mentioning, namely that at the moment, because the AI build-out requires hiring more people, it requires buying more memory, more chips, more equipment, buying land. It also involves construction. That means that in the near term, AI is actually inflationary. But once AI is adopted and deployed and implemented, then we should expect to see that AI will be disinflationary. And we'll probably also have some important impacts when we think about who it is that's impacted. Namely, we could almost begin to see a reversal of the K in the K-shaped consumer, whereby the high end is going to see lower wage growth, is going to see lower job growth, whereas the lower leg of the K, blue-collar workers, are probably going to ultimately still see stronger wage growth, ultimately also going to see better job growth, because AI is mainly hurting those who have more skills, who have more education.
All right, Torsten, got to leave it there. Really appreciate it. Torsten Slok, chief economist over at Apollo. Some breaking news crossing the wire. This from the New York Times. This involving situational awareness, and this involving subpoenas apparently being set by the Security and Exchange Commission as it looks into exactly what transpired with the near calamitous situation with situational awareness, as well as Citadel stepping in to buy up some of those assets. We're going to get you some more details on that. We'll be back in a moment right here on Bloomberg. We want to go back to that breaking news involving situational awareness. The New York Times is reporting that regulators at the Securities and Exchange Commission have sent subpoenas to the major Wall Street banks seeking information about exactly what's transpired. Now, according to that report, the Times is saying that the investigation specifically centers around how the banks actually handled the hedge funds trading, as well as some of the borrowed money that might have led to some of the issues that it dealt with. Again, this is coming from a New York Times story citing people familiar with the situation, and again saying that subpoenas have actually been sent to the major Wall Street banks. The story also says that the banks were reached out for comment, and they have yet to respond to that request. Another redhead also crossing the wire, too, I just want to point out, involving Aggreko. This is basically a power company. Remember, it traded on the London Stock Exchange for years. It was taken private back in 2021, now controlled by I Squared and TDR Capital. We're now learning, based on a filing that it has made, that it has filed for an IPO on the NYSE. It will be under the ticker AGKO. Sky News had reported earlier this week here that the company was looking to come to market in the U.S. at a valuation of roughly about $20 billion. All right, let's check in on what's happened here earlier in the cash session in markets, with the S&P 500 ending the day down by about 0.3%, as a lot of people now in a holding pattern over some key economic data on Wednesday. And, of course, a big earnings report on Wednesday as well. Your 30-year yield slightly lower here on the day. Big softness now in the Canadian loonie on the back of the breakdown in those U.S.-Canadian trade talks. And look at Brent crude, down about 3%. We're going to talk a little bit more about that when we come back after the break with Ed Morse.
President Trump has taken action that his predecessors have long deferred. And under his leadership, America is no longer managing the Iranian threat. We are ending it.
And that was Scott Bessent, the U.S. Treasury Secretary, earlier today unveiling what he called, quote, Economic D-Day, a campaign to sever Iran completely from the global economy. Now, not a whole lot of reaction in crude oil prices. Brent crude down about 2.5%. It was already sort of trending in that direction before those comments, but a lot of investors still trying to wait for more details about exactly what this D-Day looks like and what the impact will be on oil and energy markets. Joining us right now is Ed Morse, Senior Advisor and Commodities Analyst over at Hartree Partners. Talk a little bit more about what this means. We should just point out, Ed, this was not a whole lot of detail as to exactly how this is going to work. But I guess my question for you is that for a country in Iran that already seemed relatively economic isolated, how much more pressure can be put on them? And does that have an impact on oil prices?
It's a lot of pressure on Iran for sure. Whether it has an impact on oil prices is another matter. What's had an impact on oil prices, of course, is the effective blocking of any Iranian oil exports, which has been going on for a bit of time now. But Iran really has a very difficult time getting oil to pass through the U.S. blockade. So the oil market impacts of that, obviously work over time, but there's nothing incremental on it with these new sanctions that are really trying to deprive Iran of getting involved in any other international transactions, buying anything through any mechanism from anyone. And the initial soundbite went out to 60 countries.
Right, and absolutely. And I mean, most of the speculation seems to revolve around what might involve China and trying to shut off their ability to access some of these products. I mean, I know there's sort of the official numbers of what we know China has been buying and maybe some of the unofficial numbers, but they are a big buyer here. If there was some sort of real mechanism to cut that off, whether diplomatically or otherwise, does that impact the market?
Has impacted the market in an indirect way. Certainly, you can think of most of the oil that was being exported from Iran through the spring going into reserves or preventing reserves from being depleted. And that's a different issue from the consumption side. China has managed to reduce dramatically their consumption of both gasoline and of diesel, both in negative territories. They were reaching a peak already, and now they've accelerated it through public policy, and that's certainly going to continue. They have population that is not growing. They have managed to reduce driving, and they are kind of at the brink of what could happen to them. But they've taken actions to make sure that they don't have to export more than their need to consume, so they need to refine less. And as the price reaches high levels, they don't want to buy it anyway. But there is no doubt that China and its own actions in depriving itself of a combination of oil for refining and then of products to export have done a lot to keep the balance in the market. They've done almost as much in a way as the IEA countries have in putting oil on the market. And that's something that we're going to see ending sooner than we're going to see any big change on the Chinese side.
Well, I am curious about exactly where Iran's leadership, if we can call it that, actually stands in all this. I mean, we saw they're basically standing up, or at least refusing to give in to the military bombardment. Is there some sense that the Republican Guard or whoever's really running things now might be a little bit more receptive to talk because of the potential economic impact of whatever Besant and the U.S. are about to roll out?
Well, I think we're seeing that being played out right now. The interesting thing will be what the results will be. But we've had the president of the country, an elected official. We've had the head of parliament, the speaker of parliament, another elected official. We've had the foreign minister, another kind of elected official, all saying that it's time for Iran to do something to deal with poverty at home, to deal with 80% inflation, and to deal with the very unhappy public. Now, the question is the IRGC encouraging this, or are they doing that this against the IRGC. I would say they're not that bold. So I'd say that this is an IRGC effort to try to alleviate the pressure, to try to find another period of time when the Strait of Hormuz will be open, and the leadership would not be doing what they're doing in opposition to the IRGC. I think they're really the factor behind the scene. And you can see that in other areas as well. Over the last week, the IRGC has been masterminding stopping the supreme leader and the theologians from getting involved in national security in a direct way. And they've now done that in two different ways. One is that they're keeping the supreme leader out of selection of people involved in intelligence, including, the head of intelligence, saying, and convincingly so, that you don't need theological background to be an expert in intelligence, and it may be something that, turns you aside. So they are reducing the nature of the regime, but they're recognizing that the public is very unhappy, and is very unhappy because of the economic stress it's under.
Do you anticipate, Ed, that we will see at some point a return to normalcy with regards to access through the Strait of Hormuz? Basically, what was free reign prior to the war starting basically 6 months ago, because even if Iran comes to the negotiating table, there's been a lot of discussion about whether they would control the Strait of Hormuz with Oman, charging tolls, et cetera, et cetera. What is your vision for what potentially the Strait of Hormuz will look like in the future?
When you think of the future of the Strait of Hormuz, you need to think of three things. One is who's going to be ruling in Iran. A second is what are the exports going to be through the Strait of Hormuz? How much is going to go through other mechanisms, and how much is going to just decline as a result of the decline in oil demand around the world? So these are three things that have to be taken into consideration. Certainly, the world has changed in that we have Iran and Oman looking at ways to regulate flows through the Strait of Hormuz. One can argue that's always been a desirable factor, which has been ignored. Somebody ought to be looking at safety of vessels going through the Strait of Hormuz, who is certified and who isn't. Certainly the encouragement of shadow fleets has not encouraged that. So if there were to be an overall agreement among all of the countries that are on both sides of the Strait of Hormuz about certification, about charging for the inspections, that would be a different matter from Iran using its muscle power. We are now at a point again where the U.S. is putting pressure on Iran, and part of that pressure will be certainly on the Strait of Hormuz and what can pass through and what can not. So we'll see whether, and it's an open-ended question, the IRGC decides to do more bombing of more vessels. They've allowed more to go through. Particularly, they've allowed shuttle vessels to go through, and including shuttle vessels that are reloading VLCCs. East or south of the Strait of Hormuz, depending on how you look at it, who are heading east, and particularly to China, and to a lesser extent to India.
All right, Ed, great stuff. Always appreciate it. Ed Morse over at Hartree Partners there. A closer look there at the situation in the oil markets and Iran. When we come back, a closer look at the situation with the dollar on the back of the Treasury's buyback plan. Ed Al-Hussainy over at Columbia Threadneedle. He joins us next here on The Close, right here on Bloomberg.
This is not a U.S. phenomenon in regards to 30-year yields going higher. Actually, U.S. is the last major developed market to the game of steepening yield curves. This is a global phenomenon, and there's reasons behind it. So it's going to be very hard to fight it.
Earl Davis over at BMO Global Asset Management talking about some of those U.S. efforts to rein in long-term borrowing costs. And well, he's not necessarily buying it, and neither is Citadel, sounding the alarm on Bessent's buybacks, warning that the move, quote, amounts to financial repression at the margin, preventing treasuries from clearing at lower prices, does not eliminate that pressure. Citadel says it merely shifts it elsewhere, like to the currency markets. Ed Al-Hussainy joins us right now, portfolio manager over at the Columbia Total Return Bond Fund at Columbia Threadneedle Investments. And I do want to start there first with the currency markets, and specifically the dollar, which at least in the short term appears to be the loser in all of this. Ed, is this just a quick reaction function, or is this kind of the structural story?
I think the broader story in the dollar has been relative stability, particularly versus developed market peers. But when you look at it versus emerging market peers that are powering the carry trade, this gives the carry trade a little bit more oxygen. It keeps a lid on U.S. rates. And therefore, to the extent that people were afraid of maybe the Fed accelerating hikes, people were afraid of long end rates rising in a disorderly manner, this takes that risk off the table, at least temporarily.
Yeah, I mean, 7 straight consecutive quarters now, we've seen the carry trade outperform. I'd be remiss, Ed, in not pointing out history and that trade can, let's just say, turn on people pretty quick.
It is definitely long in the tooth. It's been an unusual environment in that, emerging market central banks have front-run inflation, I think, much more aggressively than the Fed had. And the inflation-adjusted real yields in many emerging markets, look at Brazil, look at Mexico, Colombia, South Africa, are in a very attractive place relative to the Fed that has found itself perhaps a little bit behind the curve, particularly this year.
Well, I mean, when we talk about the carry trade, though, and the rate differentials, I mean, some of that is also a function of economic activity. And we've talked with a couple of people on this program today that are still pretty bullish on U.S. economic activity, U.S. economic growth. Does that end up maybe being what keeps this trade going?
Quite striking. If you told me at the beginning of the year that, the unemployment rate could end 2026 with a 3 handle, that inflation, core inflation on a year-on-year basis would also have a 3 handle at the end of this year, and growth would be somewhere around 2.5%. I would have said we would have had a really strong dollar. U.S. risk assets have done extraordinarily well this year. It's attracted capital, and yet the dollar is largely moved sideways. So in many ways, it's underperformed some of the domestic fundamentals, and I think in large part because the Fed has been slower to reprice relative to some of those other central banks.
I do want to ask specifically about Bessent's actions. Bessent, who himself will tell you he is an economic historian, as somebody who fancies himself an historian as well, I went back and tried to find, sort of when we had interventions like this that succeeded, when we had those that failed. It's a spotty record. Obviously, Operation Twist, which is more Fed than Treasury, definitely sort of succeeded, at least the most recent Operation Twist, I'd say. But then you go back and you look at others, and I am curious as to what history should be telling Scott Bessent about what he's doing and whether it is wise.
Yeah, I mean, I think the ultimate lesson in history is you need a really large stick to make this intervention successful. And that large stick in the U.S. is the Fed's balance sheet. I think when you look at interventions both in the early 60s, the Fed's QE2 program in the 2010s, both of those relied on the Fed's balance sheet to give the Treasury firepower, to essentially leverage the Treasury's intervention in this market. What we're doing right now, I think, has really powerful signaling, but it doesn't have a lot of firepower behind it. And so I think the lesson of history is you need to back this up with actions, and you need to use the Fed's balance sheet ultimately in this effort. Otherwise, this is going to be a very short-lived intervention.
Well, I mean, that gets to the idea, though, too, about some of the reports, unconfirmed reports, we should say, about the Treasury maybe using its general account. It's basically just a little bit under $1 trillion, obviously nowhere near the Fed's balance sheet of, $6-7 trillion, whatever it is today here. So a fraction of that, but could that actually be, if you will, the balance sheet that maybe actually gets this home?
I think the short answer is no. The Treasury needs that cash for other purposes, for day-to-day liquidity. And so the amount of cash that's actually available for the purchase of long-term bonds, I think, is going to be quite limited. And I think the bigger picture is if the Treasury is using the TGA to purchase bonds, to put on the Fed's balance sheet, that starts to conflict directly with the Fed's independence and the Fed's monetary policy stance. That's a really uncomfortable position to be in for the FOMC and for the Treasury, for that matter. So I think to the extent that they're going to be using a little bit of cash off the TGA, it's going to be pretty small. The ultimate decision has to come down to how much are we going to issue in that longer part of the curve by the time we get to 27 and 28? And I think there the Treasury has a little bit more discretion.
All right, Ed, great stuff. Ed Al-Hussainy, portfolio manager of the Columbia Total Return Bond Fund over at Columbia Threadneedle Investments. As we continue our coverage here on The Close, we do want to bring you some breaking news. This out of Washington, this out of the Supreme Court. The Supreme Court said to be siding with the President of the United States for now on his mail-in ballot curbs. Of course, this is going to be a big fight heading into a midterm election at the start of November. We're now told that the U.S. Supreme Court has sided with Trump for now over his plan to use the Postal Service to impose broad restrictions on the distribution of mail-in ballots. We'll be back in a moment. This is Bloomberg.
An attitude at the negotiation table that Canada is a subsidiary of the United States. The Canadian industry is going to be disadvantaged relative to American industry. That we're going to set up terms so that over time, Canadian industry is going to face constant headwinds. That's not something we're going to accept.
Prime Minister Mark Carney of Canada warning that his government is still working on options for retaliating against that fresh tariff threat from the United States. Joining us right now is Andrew DiCapua, principal economist over at the Canadian Chamber of Commerce. And of course, a lot of focus, Andrew, particularly on those auto tariffs, which could double to 50%. Canada's already been trying to weather this now for the last couple of years here. What other options does Carney have?
Yeah, good to be with you, Romain. Well, tensions are high, emotions are high, and you can kind of see the strong demeanor of the Prime Minister. What we're trying to do in Canada, of course, is focus on what we can control. That's building a strong domestic economy. We have an upcoming investment summit where global investors are going to be coming to look at opportunities in Canada. So, as one of the best risk managers, former central bank of two central banks, England and Canada, Prime Minister Carney is in risk mitigation mode and walked away from the table as a result of, unfortunately, a deal that we could not agree upon.
I'm curious about the economic impact, though. I mean, does this put the potential for a recession for Canada back on the table, assuming that there isn't a resolution by the end of the year?
Well, we're in a tit-for-tat tariff situation right now. So, of course, tariffs aren't great. Consumers pay higher prices. I would note that prices in the United States are, growing at above 3%. Central banks looking at potentially, hiking interest rates as a result. So tariffs do have an impact. Canada does plan to put on retaliatory tariffs. That's going to impact Canadian affordability at a time when gasoline prices are already elevated. So it's not a great time where we're in a tit-for-tat situation for affordability. This is raising the cost of doing business, both in the United States and unfortunately in Canada. And so, the hope is that we get to a resolution as quickly as possible and move past this. I would note that we are losing a little bit of the plot here, right? This is all about North American competitiveness. This was a deal before the trilateral deal.
Yeah, absolutely. And I just want to point out, though, I mean, Carney did kind of address the retaliation, basically said that doing dollar for dollar obviously just isn't practical given the disparities in the two economies here. But it does give the idea as to maybe what Ottawa could target to sort of, gain some sort of leverage here and avoid the worst case scenario.
Yeah, unfortunately, in these situations, these tariff lists are calculated to have the maximum amount of pain. Of course, there are some symbolic elements to the United States putting tariffs in the latest round on hockey sticks, right? So, it's not like we can sort of counter dollar for dollar in terms of retaliation. But I think there is some silver lining here in terms of leverage for Canada, in terms of the United States does need our energy, our natural resources. Critical minerals are going to be very important, especially in the age of AI. Economic security is becoming more important for the United States. So you want to partner in Canada. And so this is why, the tone from the U.S. administration, this harsh tone, is rubbing the Canadian administration and Canadians the wrong way.
Real quick here, only about a minute left, Andrew, but I am curious about, you talk about North America. I mean, the latest USMCA review, I think, is up ahead. I assume that there's not much going to happen there unless Canada and U.S. sort of resolve this particular tariff situation.
Yeah, unfortunately, we don't, as signaled by the Canadian administration, American administration, it's not sure when we're going to return to the table and get to constructive talks. It's in the interest of both countries to get back to the table as quickly as possible. I'm not sure how the U.S. midterms are going to play into that in terms of timing, but of course there are new tariff threats this morning from the president on raising those tariffs as January 1st of next year on a number of different goods. So unfortunately, the tensions are high. Hopefully, we can cool things a little bit and return and get to constructive talks between our two countries.
Andrew DiCapua, really appreciate it. Principal economist over at the Canadian Chamber of Commerce. All eyes, of course, on the political situation going on between the two nations. But meanwhile, all eyes still back on the market as we set you up for what to watch over the next 24 hours. That includes earnings before the market out of Dick's Sporting Goods, earnings after the market out of Zoom and Intuit, economic data from the Conference Board, particularly when it comes to consumer confidence. We're also going to get a read on new home sales, as well as that Richmond Fed Manufacturing Index. And speaking of Richmond, we're going to hear from Richmond Fed President Tom Barkin. Fed speak tomorrow. And then back in the world of politics, South Carolina holding a special Republican primary runoff for the U.S. Senate seat to replace the late Senator Lindsey Graham. Balance of Power is coming up next at the top of the hour. I'm sure they'll have a lot more on that situation in South Carolina. I'll be back with you tomorrow here on The Close with all your market moving coverage right here on Bloomberg.